Federal Reserve Chair Jerome Powell struck a cautious tone this week, acknowledging the difficult balancing act the Fed faces: inflation risk on one side and a slowing labor market on the other. Speaking at an economics event in Rhode Island, Powell said current interest rates remain modestly restrictive and well positioned to address either threat, suggesting the Fed is not in a rush to cut rates aggressively. Powell emphasized that tariffs are likely to cause only a temporary bump in prices, but warned against letting those one-time increases turn into a more permanent inflation problem. "We can't leave that part of the goal unguarded," he said, signaling that while rate cuts are on the table, the Fed remains cautious. The backdrop is complex. Last week, the Fed cut interest rates for the first time since December, and future markets are pricing in 2 more cuts by year-end, bringing rates to their lowest since 2022. But policymakers remain divided. Some, like Fed Governor Michelle Bowman, warned that the labor market is weakening faster than expected and that the Fed risks falling behind. She highlighted fragile job growth and rising unemployment as red flags that may warrant faster and larger cuts. Others, including Chicago Fed President Austin Goolsbee, stressed that inflation remains above target, urging caution before moving too quickly. Similarly, Atlanta Fed President Raphael Bostic warned that businesses still expect prices to climb further, keeping inflation risk alive. In short, the Fed is navigating a two-sided risk. While job growth is slowing, inflation hasn't fully cooled. For investors, this means markets may continue to swing as officials debate the pace and scale of cuts. All eyes will now be on the Personal Consumption Expenditure Report, the Fed's preferred inflation gauge for the next signal on policy direction. Follow us for more market analysis and updates just like this.